Chasing quick profits. This mistake happens when investors focus only on short-term gains instead of long-term value. It often appears when someone hears stories about people doubling their money in days and assumes the same will happen again. The desire for fast results can push individuals to buy assets that are already overvalued or trending temporarily. Historically, market bubbles, such as the dot-com boom in the late 1990s, showed how many people rushed into investments simply because prices were rising quickly. When the excitement fades, the price usually corrects, and
Investing without understanding. This error occurs when money is placed into assets that the investor does not fully understand. Many people purchase stocks, funds, or digital assets simply because someone recommended them. Without knowing how the business works, how the asset generates value, or what risks exist, it becomes difficult to make rational decisions. Over time, this lack of understanding can lead to panic selling during normal market fluctuations. Investors who study what they buy usually develop more patience because following the crowd. Human beings naturally look to others when making uncertain decisions, and financial markets are no exception. This behavior leads people to buy when everyone else is buying and sell when fear spreads through the market. The pattern has appeared many times throughout history, from the tulip mania in 17th century Netherlands to modern cryptocurrency surges. When decisions are driven by social pressure instead of careful analysis, prices often detach from real value, creating conditions. Ignoring diversification. Placing all capital into a single investment exposes the investor to unnecessary risk. Diversification developed as a principle in modern portfolio theory during the 20th century, emphasizing that different assets respond differently to economic conditions. When one sector declines, another may remain stable or grow. Without diversification, a single negative event, such as a company scandal, an industry shift, or a regulatory change, can severely damage the entire portfolio. Trying to time the market. Many investors believe they can consistently predict the perfect moment to buy at the lowest price and sell at the highest point. In reality, financial markets move according to countless factors, including economic data, global events, and human behavior. Even professional fund managers rarely succeed at timing every movement. Attempts to jump in and out of the market frequently lead to missed opportunities, especially when long-term growth happens during a small number of unpredictable days. Letting emotions control decisions. Fear and excitement are powerful forces in investing. During periods of rapid growth, people may become overly confident and invest more than they planned. During downturns, the same individuals may sell assets simply to escape uncertainty. Emotional decisions tend to happen quickly without careful evaluation of the underlying value of the investment. Experienced investors try to rely on structured strategies and patience rather than reacting to every.
Neglecting long-term perspective. Wealth in financial markets has historically been built through time rather than sudden movements. Many of the most successful investments, such as broad stock market indexes, grew steadily over decades despite temporary declines. When investors focus too heavily on daily price changes, they may abandon strategies that would have worked if given enough time. Maintaining a long-term outlook helps reduce the overconfidence in personal skill. After a few successful investments, some individuals begin to believe their results are entirely due to personal insight. This confidence can lead to larger and riskier positions. However, markets are influenced by many variables beyond individual control, and early success may sometimes come from favorable timing rather than superior strategy.
When investors assume they cannot be wrong, they often stop evaluating risk carefully.